on our radar. Now, the net earned premium rose 15% year on year, while the underwriting profit was down 9% for the company. To talk about the numbers, our colleague Yash caught up with Nilesh Kambli, Chief Financial Officer of Star Health and Allied Insurance. Let's take a look at the chat.
The net earned premium is a function of growth of last year and current year because we are following 1 by 365-day method. So 15% growth is typically an average of last year growth, which was 13% for us, and current year growth, which is around 18%. So that is how the growth in earned premium has panned out for the first 9 months. And in Q4 as well, we expect a similar trend to continue.
Okay. Of course, if you could take us through how the group and the retail portfolio is expected to perform for you?
See, in the retail segment, we continue to grow at the market growth rate and we have maintained our market share. When it comes to the growth in business, we are focusing on quality business with a risk-first strategy, and we'll continue to grow, in line with or above the market growth rate in the next 3 months as well as medium to short-term period. When it comes to group, there are 2 segments. One is the employer-employee group and the non-employer-employee group. The non-employer-employee group consists of the banca business, which continues to do really well for us. We have 48 partnerships and we are continuing to grow at upwards of 40% in this segment when it comes to new business. On the employer-employee side, we are focusing on SME business, which is profitable. We have built up a team. It is slightly taking time, but Q4 looks to be good, and we'll again continue to grow in this segment as well.
Okay, Nilesh, what I want to understand from you, the last few conversations which we've had with the company also, the focus in the recent few quarters was to sort of shift towards a retail business, because of course that gave you better margins, it has better prospects, and move little bit away from the group business. What was the target in terms of mix that you had between retail and group that you had in mind? Have you achieved that or not? If not, then how soon do you think you'll be able to achieve that desirable point in terms of mix between retail and group?
So basically, this journey started early 22-23, and group policies are 1-year policies. So as we speak, the transition is already over. Currently, our group business is roughly 6%, and the balance is the retail business. There is no specific target in mind per se, but as a group, pricing is becoming stable and it is improving. We would like to grow in the group segment as well. The long-term, goal will be to ensure that it is in the range of 90-10, 90% retail business and 10% group business.
Okay.
That is how we are working.
Okay. So, I mean, you've sort of cued me to my next question, which is that, why focus on one segment and move away from the next segment? Why not grow both segments, which sort of helps your premium growth? So, from what I pick up in terms of what you said, the group business could see some growth in the coming quarters. As you said, 90-10 would be the likely scenario. So, from 6%, it could, be seen growing towards that 10% mark?
That's correct. See, basically, the objective is to grow both the businesses. When it comes to retail business, we have mentioned that we'll grow in line with or higher than the market growth rate and continue to improve market share. So there is no slowing down of the retail business. But when it comes to group business, our market share is less than 2%. There is a huge potential and opportunity available when it comes to SMA businesses. The rates are improving. So when we talk about shifting the business from 6 to 10%, the growth will be much, much higher compared to the retail business. And the overall business will continue to grow.
As you said, group moves from 6 to 10%. There will be a higher growth on the aggregate level. So for FY25, what could be that possible growth as you move from that 6% to 10% on the group side?
I mean, we'll not give a number, but it will be, yes, it will be much higher than our normal growth rate as we keep on continuing to improve our contribution towards the group segment. It will be much higher.
Okay. I want to understand something on the combined ratio as well. Now, of course, if you look at the general insurance industry, they operate anywhere between 102 to 110 to 115% of combined ratio, but understandable because they have more segments which may get them those losses. For Star, it's one segment in terms of health insurance. Then in that case, what should the market look at as a desirable combined ratio for a standalone health insurance company according to you? And of course, which applies on Star as well. And how close, how far are you from that desirable combined ratio according to you?
See, when it comes to general insurance industry, the combined ratios are much higher than 100%. Initially, it was the case when the motor third-party loss ratios used to be higher, but with motor third-party loss ratios also coming below 75-80%, it's very difficult why the combined ratios are higher. Having said that, when it comes to health insurance companies, we want to be profitable. The desirable combined ratio is anywhere close to 95%, 1 or 2% lower or higher. So that's a desirable loss ratio, combined ratio, if you want to do a profitable growth and an ROE which is upwards of 16-17%.
Thank you. That's Star Health for you. We'll thank Yash for taking us through this conversation. We will slip into a very short break. On the other side, the initial public offering of the hotel chain company Park Hotels has opened for subscription today. They're looking to raise about 920 crore rupees. Why this issue? We get chatting with the chairperson of the group, Priya Paul.